Well, thank you all for joining us here in early January. Recognize there is a weather pattern apparently that a lot of folks are getting ready for across the country, and at least here in the DC area, there's quite a bit of excitement about the snow that's supposed to arrive over the weekend. Hope everybody stays warm throughout that time. Before we get too far into the conversation, did want to acknowledge that in the course of the last couple of weeks, it's been a very busy period with news flow seemingly quite constant. Every day we're waking up to different headlines, different news, different information, and that feels like a state of affairs that we've been living in for a long time, not just the last couple of weeks, right? It goes back many, many years. We're going to do our best to walk through everything that is happening out there that is relevant and pertinent to investors, to the economy, and thinking about our framework for building portfolios over the course of 2026. What I would say is relatively difficult for us to cover everything. There's just a reality of we can't go through every single topic. I know a lot of questions were submitted prior to the webinar. So we'll do our best to unpack what we see impacting the market and the economy as we step forward this year. Just recognize, we can't quite get to everything that's happening out there, but if you do have other questions, we are always here and accessible, wanting to have a conversation with people. So please don't ever hesitate to reach out to your advisor, reach out to Dimitri and myself. We do stand ready to support as we navigate markets and what's happening. So we're going to go ahead and get started. Dimitri Katz-Nelson is also joining me on the call today. We'll walk through state of affairs for the economy, what we see taking place in the equity markets. We would be neglectful if we didn't talk about artificial intelligence and what the state of affairs is for AI. And then we'll walk through bond markets and the outlook. So Dimitri, if we get into the markets in 2025, a bit of an unusual path that we followed, but the market did, particularly the stock market did what it always does, which is not the average. We've talked about this before, that the average market return over the course of the last 100 years is around 9%, and yet the number of times we've actually had a 9% return in a year is what, 1 to 2 times out of those 100, and that's what we got again last year. So why don't you walk us through it a little bit?
Well, I'll focus on the bad since I'll do the half class empty side. So obviously, very strong year for stocks and bonds, and we're going to touch on that all the way through. But to a degree, this is providing context on why you don't chase every single headline. So if you just thought about the tariffs, I think which the extent of which surprised many folks weren't surprised about tariffs coming, but just the amount. The U.S. credit downgrade. You had dollar weakness in the first quarter into the first half of the year. You had the longest federal government shutdown on record. And you had some sticky inflation in the first half of the year. And if that was the entire story, this will be somewhat shocking. But the reality is this is not all of it, right? We had some positives as well, right? Oh, Chris, we touched on a few things, but even just the Fed, right? The Fed was quiet up until the end of the year and then cut 3 times. So you have accommodative fiscal policy. OBBA, right? The big beautiful bill, which we'll touch on a bit more, brings sorry, that was monetary policy, fiscal relief, and you had very robust earnings, you had robust growth, and you had very few defaults. So if you add all of those things to all the negatives, you can end up in a place where bonds are up, stocks are up, and you actually have a diversified portfolio doing quite well. But let's jump into how this is translating to the future as we look at some of the
Yeah, well,
economic
and,
things.
and the important part here is that you had the fiscal support, like you mentioned, and that was the passage of the OBBBA during the summer months. That did create a bit more of a fiscal push, so money coming into the economy. You also had the easing of monetary policy. That one thing people often forget is that monetary policy does not flow through to the economy immediately. It does happen with a lag. By some accounts, that's as long as 12 months or 18 months. So our economy economy is only now beginning to feel the impacts of, hey, that first Fed cut that took place in September, that was the first one that had happened in quite a while. We'll now begin to see that in mortgage borrowing rates potentially. We'll see it in consumer loans where rates are beginning to go down in the last few weeks and months. And then on the corporate side, when you see what the S&P had done last year, people assume that because the stock market went up 17%, it must mean that stocks got more expensive. And that's the one surprising element of last year. The stock market itself didn't actually get dramatically more expensive from January 1st to December 31st. So when you're looking at price to earnings ratios or price to cash flow ratios, market is a little bit more expensive, but earnings grew 14 to 15% for the S&P 500 in last calendar year, which is roughly equivalent to how much the price was up. So, where we started and where we ended, not necessarily more expensive. And we have other things that we'll talk about on the outlook for this year that prove to be supportive. The one idea that I don't want to neglect to forget here is with the bond market. We now have 3 years in a row where the bond market has been up, and that came after the experience of 2022, which was a very difficult one and not one that we hope to see happen again. When interest rates went from effectively 0% up to 5%, that led to bonds not doing well, obviously. And what we see now is that 3 years in a row, bonds have done better. They provided more ballast in portfolios. You go back to March, April, and May of last year, stock markets were going through that tariff surprise moment, and stocks were beginning to sell off in a pretty dramatic fashion. Bonds held up, and so it's a good reminder as to why we have asset classes like that within portfolios. But nevertheless, as you can see, it was a busy year. And the first 2 weeks of this year have already proven to be, I guess we're into week number 3 now, have already proven to be pretty busy too. So I want to walk through a few items on the economic front, and Dimitri will join us throughout to talk about what's going on. The biggest thing as we see it is the Fed's dual mandate boils down to employment and what's happening there, and then maximum stable prices. So when you think about that maximum employment, the dynamics have changed, especially going back to May of this year. Go all the way back to 2022. We were coming out of the COVID shutdowns and what was happening to the economy. You can see non-farm payroll growth was around 5 to 600,000 in a number of months, began to slow down throughout the years after. Starting in May of last year, the labor market had effectively closed, just meaning that there was not as much hiring as previous, and we didn't see that layoffs had picked up in any substantial way. So there have been moments of layoff. If you think back to Doge and the federal government workforce in February and March, and a little further into the year last year. But the labor market overall has been in a stall mode, in a stall state. So when you're thinking about why the Federal Reserve cut interest rates and tried to lower interest rate policy, part of it is that they see this happening as well, and they're beginning to ask, how do we get more people back into the workforce? Two things are happening here. One is potentially productivity growth associated with AI, or companies beginning to extract more productivity growth from AI and artificial intelligence. And is that leading to them not needing as many employees? Potentially, we see very limited evidence of that being the case just yet. There's a number of different academic papers. There's some research on this topic, and it's not quite arriving at that conclusion just yet. The other fact of the matter, though, is the slowdown in hiring coincided with when tariff announcements really started to go into force. So, what we could surmise is that companies were beginning to say, I'm not totally sure what's going to happen with our business prospects as we flip the calendar into 26. I need to let tariff policy settle in, arrive at a final state, and then we can formalize our hiring plans and intentions. So this was a big development as we got into second half of 25. And when we're looking at, under the hood, what's going on, it's not so much the prime workforce, so the prime working ages of 25 and above, that are feeling the effects of changes and evolutions in the labor market. It is really happening for younger demographics. So those individuals 16 to 19 that might be working in part-time jobs while they're in school, or in summertime jobs over the summer months. But we're also seeing it happen for new college graduates. So the unemployment rate, as you can see with that orange line there in the middle, for 20 to 24 year olds is rising. It was at one of the lowest levels in decades when we go back to 3 years ago. It has been rising pretty consistently, getting a little closer to where its long-term average is. But if you're going to ask questions around impact of AI on labor force, this is one area where it is starting to show up, and the research is suggesting that, particularly for new college graduates, the opportunity to find employment is getting more difficult in the last 12 and 24 months. So that's something to keep an eye on. As we think about labor markets where they are today, economy is still relatively strong, and we'll talk about that. So it's possible that we see a pickup in hiring throughout the course of this year, just to match where economic growth is going. We're not seeing that, as just in these first couple of weeks. The other trend that is evolving and want to keep a close eye on is with regards to inflation. Inflation has been such a big story and such a big headline for the past 5 years, really kicking off in 2020 and then staying with us pretty much ever since. When you're looking at the big contributors to inflation, there are a few things that are beginning to change. And that happened right around March and April of last year. So what you're looking at here is headline inflation, or that CPI number, which is that line running across the screen from left to right. 2.7% is where we ended the year with inflation. So prices were up about 2.7% year over year. And then as you look at the underlying subcomponents and what's contributing there, services inflation has been with us for a long time, predating 2020, predating, even 2019 and earlier. Services inflation talks about childcare costs. It's a reference to the expense of college tuition. It's thinking about, if you have medical expenses, all of that is being captured within that bucket. And as many of us probably see in our everyday lives, that cost has been rising faster than inflation elsewhere. The change, though, was looking at goods prices, looking at food costs, and looking at energy costs. So we saw in particular that the price of goods started to go up in the second half of last year. And that was coincident with the period of time when companies began to say, all right, we were absorbing tariff costs for some set amount of time. We purchased goods in advance. We had stocked up. We were ready for what was coming, but we've now moved past that moment. And as we move past that moment, companies started to pass that cost along to consumers. And we are seeing that there's more and more evidence of that happening. So as you look across the inflation trends right now, the services piece is staying relatively sticky. The only exception to that has been apartment rental prices, which are starting to flatline, and in some parts of the country are actually beginning to go down. Goods prices are going up. Food costs have more recently begun to go back up. And then we also have energy prices, which are now picking up. Part of why energy prices are going up is simply that they had fallen a lot in a few years' time. So we've now seen, as you think about the input cost, whether it's for businesses or whether it's for consumers, that's starting to go higher. So those are our two big forces on the economy as they've been playing out here recently. The other one, which is part of what Dimitri's reference was to why the stock market was selling off, is tariffs. Right here, you can see tariff revenues on a month-by-month basis, how much was collected going back to 2005. And last year was a banner year, if you want to call it that, in terms of tariffs and collections being over $250 billion. So we had tariff collections of around $250 billion over the course of the year. And the number is actually a little bit higher than that. But you can see what happened month by month. The numbers started to increase slowly, and then suddenly it started to increase a lot more dramatically as tariff policy came to fruition. Now, the question we often get is, why didn't this slow the economy down? Well, part of it is that the proportional size of goods that we import from overseas is relatively small when you look at a basket of how people are allocating their money and how they're spending their money. So yes, the impacts are there and they're certainly being felt. But in proportion to everything else that people spend money on, the tariff impact has been somewhat manageable, at least up until this point in time. The longer it goes on, the more that dynamic begins to change. And we already know that there has been an easing of some tariff policy that was put in place previously. There's also the discussion at the Supreme Court as to whether tariffs are going to be overturned and if they're going to remain in force. We can have that conversation separately. Unfortunately, I think it would take up most of our call if we tried to go through all of the details. Now, part of what is really important to understand, and Dimitri is beginning to get into this, is the fiscally supportive measures supporting the economy. So while tariff rates were going up and tariff collections were going up, we have still been running a deficit as a percent of GDP that's around 5%. And this data now is updated all the way through the end of the year. But that deficit is still around 5% of GDP. If you're comparing that with prior moments in time, you typically see that as an economy is expanding, your deficit would shrink to around 3%, maybe 2% of GDP, and yet we're still running a recessionary style deficit despite the economy growing where it currently is. That's been true for a while. Dimitri, I see you had come
No,
back off.
yeah, I think that you covered it. It's the if you look at periods where the deficit as a percent of GDP grows, it's during recessionary times. So if you look at after the financial crisis, you look at post-tech bubble, those are the times. So running these higher deficits is definitely stimulative. But there's other things that I know you'll touch on in the coming slides.
Yeah, and you think about part of why the economy has been booming for the years after COVID. Well, take a look at the spending as a percent of GDP at that time. We spent roughly a fifth of our GDP in terms of stimulative measures, and there were fiscal transfers that took place at that point in time. That was a lot of money that found its way into the economy and has been supporting economic growth for quite a while now. And we've just never really sort of gotten back to normal ever since 2020. So that fiscal stimulus and support remains in place, and we'll show you what a little more detail on that in just a moment. But where that's led to is the economy continues to grow well, or continues to grow at a pretty strong pace. And we've also had inflation that is slowing down, albeit not yet to an area where I think anybody would call it quite comfortable. So on the left-hand side, you have forecast for GDP growth. That's is going to show you 2025 as well as 2026. And that there was that initial tariff shock that took place. We've shown this before. We've talked about this before. And after that began to settle, after we started to reach a state of equilibrium, economic growth forecasts began to go back up. And by the end of the year, we're now looking at the economy growing on a real basis north of 2%. And for this calendar year, that's likely to be repeated. So that's an indication of an economy that is doing quite well, especially at the size and the maturity and with the size of our population. That's still an economy that's doing well. The thing to keep an eye on is the right-hand side. Those inflation forecast started to go up around the tariff announcements last year, started to come down a little bit, particularly for 2025, but they haven't come down enough. And this is where the Federal Reserve is saying, well, we don't really need to cut interest rates further because we have this inflation worry and this inflation concern. Are tariffs going to add more to the inflation story? And as we've been thinking about portfolio building, how we're developing allocations, we've talked for a while now about introducing Treasury inflation protected securities. More recently, we've also discussed private infrastructure. And a lot of that is really a function and a design to protect purchasing power, to build some inflation protection into portfolios. And that's one of the areas that we've spent a lot of time thinking about and talking about. But if that inflation number doesn't come down and starts to reaccelerate for some of the things that we're going to, reasons we're going to talk about in just a moment, that is going to present a risk to the markets this year. We're not yet there, but it does bear watching. So what's coming this year? Well, this gets into part of what Dimitri was teasing earlier on. When you're thinking about the OBBBA and its passage last summer, there were initial stimulative measures that came into the economy, but others were going to arrive in 2026 and in 2027. One of the big ones was an increase in the size of tax refunds. So there are some measures in there, such as no tax on tips, no tax on overtime, some beneficiary tax measures for seniors. And when you look at that, what it translates to is that tax refunds are going to grow pretty substantially this year for the first time in a while. So we had actually seen that tax refunds were shrinking, they were getting smaller, despite people taking home more pay, despite markets and financial assets doing better. You would assume in that environment that refunds are going higher because people potentially have more assets and reasons that the refund would grow, but that was not happening. So where we see right now is, if you look on the right-hand side, the federal tax refund per payroll job is going to jump to about $3,000 to $3,200, up from, let's say, around 2,700 last year. Most of that arrives early in the year. So as we know, the federal filing period is going to be, for a lot of folks, somewhere between February and April. Others will drift a little bit further on. But for those that receive a refund, that'll happen, and it'll be front-loaded in economic activity earlier in the year. So this is another one of those reasons that as you think about GDP growth and why it might be as strong this year as it was last, that there is more fiscal support and there's money coming in. The other element is where monetary policy goes from here. So we've already talked that the Fed cut interest rates 3 times last year. Right now, the market is projecting 1 to 2 cuts this year, so a little bit of a slower pace. But as I mentioned, the Fed and policy changes don't really flow through immediately. So you'll see that with respect to credit cards, which that has been in the headlines here recently. You'll see it impacting consumer loans, not as much on the mortgage lending side, but HELOCs, another example of this, where rates are going to be coming down. It'll allow consumers the opportunity to tap into potentially more borrowing. So the monetary policy and the fiscal policy is lining up together into a supportive backdrop. So what are some of the risks that we potentially see for the course of this year? There's obvious headline risks, which is always around geopolitics, and people are aware of what's going on there. Another one, though, is midterm elections. So if you go back to 1946 and look at every midterm election since, there have only been 2 occasions or 2 periods where the presidential party did not lose control of the House or Senate at the midterm elections, and normally the number of seats gained or lost is actually quite substantial. So that's where those negative bars are. That the presidential party in power loses as many as 63 seats in certain elections. That was in 2010, but it's happened with a lot of consistency over time, and this is part of where the headlines are arriving around affordability, around introducing caps on interest rates, around all of the policy and legislative and agenda items that have come up here in the last couple of weeks. It's designed to change this dynamic, to stem the tide, such that the control of the House is not going to be lost by the Republican Party, for example. Now, we'll talk about why this matters to markets and what it potentially introduces. But to give you a little preview, it introduces volatility, because the volatility is a function of uncertainty, where policy agenda is going to go if there is a split party in Washington, D.C., as opposed to unified control or a stable outcome. The other thing I want to talk about, and I was beginning to get into it there, is the idea of the headlines around affordability. And when you're thinking about where we are today, when there are a number of headlines, there's quite a few different surveys and polls out there. One of which we found was interesting, that currently millennials are estimating they spend about 40% of their paycheck within 12 hours. So the paycheck will arrive in the bank account at 8 o'clock at night, and by 8 o'clock the next morning, 40% is spent. This is telling you why the winds of change are currently blowing, and a lot of people are asking the question around, how do we address affordability? It's happening at the state level. It's also happening at the federal level. With as much as we see these federal initiatives happening, Oftentimes, affordability is more impactful for state legislatures. We're thinking about things like housing supply, for example, which is not currently being addressed. Most of the policy proposals are around how do we encourage people to borrow more money, or how do we lower interest rates so that people have better access to capital. We've been underbuilding the housing stock for about 15 years now, going back to 2008. And that trend actually got worse in 2024 and in 2025. So we as a country built fewer homes in both of those years than we had in prior years. Why? Because interest rates had gone up. So lower interest rates will help that equation a bit, but builders aren't necessarily coming back quite enough to support the level of population and household formation that's out there. So you can see a few of the dynamics that are at play. And when you look at the two bottom elements there, go back to the elections that happened November of last year. Virginia voters said economy was their number one concern, 49% of voters. When you look in New York City and we had the election there, cost of living was the cited by 56% of voters as their primary concern. You can see that when it comes to the midterm elections, it's the economy. Like that is what people vote on. They don't necessarily vote on geopolitics. They don't necessarily vote on the things that are grabbing the headlines. They vote on what their personal financial situation is and the state of the economy. Now, one last part here, and this also talks to the same idea. When you're looking at the composition of how the top 10% of income households spend versus the bottom 90%, this gives you a sense for where the affordability issues come into play. As you're looking at the bottom 90%, roughly 60% of the spending occurs and goes to things like services. So all the services that we were talking about before, 27% goes to goods, and only 2% is allocated to savings. You can see where these dynamics are very different for the top 10% versus the bottom 90%, not to mention the composition of the balance sheet, what type of assets do they own, and how are those doing in an environment where home prices are going up, where stock prices are going up. This is one of the primary issues that we see popping up. So
Yeah,
Dimitri, go
yeah,
ahead.
I unmuted. And this speaks to, I think we've mentioned this before, the K-shaped economy. One thing we say a lot about the inflation numbers that you see, that 2.7 number on services spending, including housing, otherwise, does not have assets in it. So the biggest, the inflation number that we see is what we spend money on, right? But not necessarily what we invest in, what we save. And if you are a net lender, which most of our clients are, right? Their own bonds, they lend money to the US government, to their states, and otherwise. And you have investments, which, as you saw, the stock market is doing quite well. Um, you're in a very different place from what your spending power is than somebody that saves nothing. So this K-shaped economy has been a net positive for net lenders and folks that are asset rich versus those asset poor. That's frankly no different than any other time in history, but it gets exacerbated because of that interest rate story. If you're a net lender, you want higher interest rates. If you're a net borrower, not so much. And when interest rates went from 0 to 5, that changed the dynamic a little bit. And as they get lower, it kind of brings that back a bit more towards what we saw over the last 15 years heading into 2022.
Yeah, and the reason that we raise this is because it'll continue to be front and center, and it'll be at the top of the headlines going through the election cycle up into the midterms. It's a big part of the initiatives around housing affordability, lower interest rates. This is the reason why it's coming up right now. There was a good comment submitted that I did want to raise. So, when I was talking about the housing supply, I tried to boil it down to a simple set of factors. There are always more complexities introduced. Higher interest rates did cause builders to slow down in terms of wanting to build, but there was also an increase in labor cost, which happened the last 5 years. We also saw that input costs from goods and materials went up pretty quickly as well. So yes, there are definitely more factors at play. My ultimate point was that we were building fewer homes in each of the last 2 years. And when you look at household formation, it's roughly around 1.5 million households per year. We were growing the housing stock by, let's say, around 1 million homes. So that's where you have a deficit of about 500,000, and that's come into play. So when we summarize and just think about the economy at the moment, there's a lot of support still at this point where we are. The labor markets are slowing down. That is a risk and something that we need to watch because if the labor market softens further, if we begin to see layoffs accelerate and companies are just saying, I have no need for additional employees, then that will impact consumer spending and that will begin to act as a headwind. Inflation is mostly in check, but now we're going to have the fiscal stimulus support from the OBBBA. We will also have tariff prices that continue to flow through to the real economy, although that could begin to taper off and tail off depending on the Supreme Court announcement and the impact of that. So we could still have this push for inflation to go a little bit higher, albeit not quite what it had done a couple of years ago. Don't forget in that backdrop that retail gas prices have fallen pretty far since they had peaked around $4 a gallon. We're on average around $3 a gallon across the country. If that starts to go back up, that's another one of those inflationary forces that will begin to pull CPI higher. So, in terms of the agenda for this year, affordability is going to dominate. It's cost of living, housing, food, energy bills. It's the credit card discussion. We're not going to spend as much time on that. The timeline around the Federal Reserve chair is potentially going to extend, and that will have ramifications for policy decisions as we get into that May timeframe when there was supposed to be a handoff of power. Geopolitics, that is ever present, and I just don't anticipate that it will go away. We're also going to have the Supreme Court decision that we've mentioned, and then midterm elections. What we hadn't talked about is that 10% of Congress currently is not seeking re-election, which translates to 47 members on the House and 11 members of the Senate. Certain of those are retiring. Certain of those individuals are retiring. Others are moving into state legislative roles or running for governor at the state level. There is a lot of turnover that will be taking place. This is one of the higher levels of turnover that we've seen in quite a few years. So I wanted to step over to the stock market, have Dimitri talk about the AI bubble, maybe. I don't know. We've heard a thing or two about that.
Sure. Thanks, Chris. You missed. We have the Winter Olympics and World Cup coming too. Those, though, geopolitically, you tended to see uh, some countries tend to wait until after those events to do any other geopolitical, we'll call it fun, but we know we don't mean it. So let's get into this stock market slide. So slide here is showing you what happened in 2024 and then 2025. Obviously, very strong year for stocks. But importantly, and unlike what we've seen really over the past 5+ years before that, is you saw international stocks do quite well and beat US stocks. Part of that is going to be a currency discussion, which we'll have a few slides in a few slides. But it's a very strong year for diversified portfolios. But you also saw bonds do well, right? Chris mentioned bonds up for a third straight year after one of the worst years ever. I don't know if people were that excited about bonds being up, 1% or so in 2024, but this year bonds beat their coupon, and we'll tell folks what that means going into next year. So let's jump into the stocks. We'll have a few slides on US equities and kind of addressing the bubble question in different ways. This is one of them. We just want to provide a bit of context. So this is a chart showing you S&P 500 profit margins over time. This is going back 25 years. And below you have a table showing you what the PE ratio, price to earnings ratio on the S&P was in 2005 versus what it is today. And you can see the multiple, how much you're paying for a dollar of earnings has increased 58%. And that alone is worrisome. But you also have to take into consideration what those earnings mean. And that's what we have the column next to it, profit margins. We're significantly more profitable than we were back then as well. You've seen an increase in PE multiple. You've also seen an increase in profit margins. Part of that has to do with the AIification of things and the market's just moving a lot more towards tech, a lot more towards higher margin businesses, a lot further away from industrials. But generally speaking, companies are more profitable than they have been and therefore have demanded a higher multiple. We'll provide a bit more context around that, but first let's hit on dollar because that was a point earlier in this year. So if we go to the next slide, we touched on earlier that international stocks were up north of 30%, whether developed or emerging, were up north of 30%. A good portion of that was dollar. The dollar did weaken this year. So what we have in front of you is the dollar spot index rate. This is basically a dollar relative to a basket of currencies. And we take this back to basically when we came off the gold standard in the early 70s. And All the way on the right, you can see that the dollar went, the dollar index went from 110 down to below 100, right? That's that greater than 10% decline in the dollar. So if you had non-dollar assets, they did better. So you can say that at least 10 plus percent of what international outperformance last year was because it was not dollar denominated. The reason I wanted to bring this up is that it wasn't the majority of international performance was dollars. The majority was still earnings. It was growth. It was multiple. It was all those fundamental things. The other reason we wanted to show this is that we're not too far off normal. We're kind of where we were 50 years ago. So currency volatility is always in play. And when we got these headlines, oh, good God, the dollar is gone and foreigners are not buying dollar denominated assets, not exactly the case. We don't have it here, but the net investment activity in dollar denominated assets, whether it's stocks, whether it's treasuries, whether it's agency mortgages, otherwise, was up, which means despite all the headlines, despite the tariffs and otherwise, and despite the changes in actual price, the net flow was positive into dollar denominated assets in 2025. So just be, as you hear about death of the dollar, just be mindful that that's probably a bit premature. So let's get back into kind of what was driving returns last year and kind of what's going to be driving returns going forward. And that's earnings. It's fundamentals, right? How much companies are earning and how quickly are they growing? And we have a table here showing US, Europe, Japan, Asia ex Japan for 25, expectations for 26 and 27. But if we had this going all the way back, it was a dollar denominated, it was a US denominated kind of dominant story. US equities outgrew international equities, developed or emerging for a while. So a lot of the outperformance for US equities for the past 10, 15 years was fundamentally driven. It was the earnings were stronger. You had better multiples, but also earnings were stronger. As we look ahead, you're starting to see those foreign markets catch up, whether it's Europe, Japan, Asia ex Japan, 26 and beyond. You're starting to get to a dynamic where you don't have as much of a disconnect in earnings growth. That is net positive, and that is why we're still constructive on international stocks in combination with US stocks rather than just being US centric alone. Let's get to the next one. Let's talk about valuations. So a couple of things here. Busy chart, but I want to provide a bit of context. First, as you look at this table, just think of if you're looking at light blue, dark blue, those are valuations. So the higher they are, the more expensive things are. In orange and yellow, you have profit margin and return on equity. So in the ideal scenario, you want blue as low as possible and yellow and orange as high as possible. But I think what this gives you is a pretty good idea of yes, U.S. equity large cap stocks are more expensive than anywhere else, but they also have the highest profit margin, the highest cash flow. Why we've been more constructive on markets overseas is because you're seeing that the multiple's a bit lower, but the ROE and profit margins are a bit greater. I think one more thing we want to highlight is if you look at this chart, you say, well, why in the heck would you own mid and small cap stocks? And fair, if you're looking at this is trailing data, right? And if you're looking backwards, it doesn't look great. I think one thing which Chris mentioned earlier is that as interest rates fall, that is a net positive, a lot more for mid and small cap stocks than it is for large cap. If you look at a good portion of the large cap market is actually net lenders. They have a lot of cash in their balance sheets. Higher interest rates are a net positive for them. If you're a net borrower, you want lower interest rates. So as we're seeing interest rates come in, we're starting to see mid and small cap stocks do a bit better. In the first few weeks of 2026, we've seen dividend stocks, which were atrocious last year, come back a bit, and small and mid cap stocks lead large for a bit. So again, these things shift over time. It's not necessarily a trend, but just a bit of a hopefully level setting in how we think about valuations trailing versus forward.
And Dimitri, I would say this is an important tale of the past versus the future. And when
Yep.
you look at this data, if you had gone back 4 or 5 years ago, what you would have seen is that S&P valuations were lower, and that fundamental picture was stronger than anywhere else. Speaking specifically to the S&P 500, the fundamental picture there, so return on equity, profit margins, have just gotten better and better and better for the S&P 500 over time, and much of that boils down to the Magnificent Seven. Those stocks had been carrying the market for quite a while. We've seen that valuations are now higher there. Valuations are better elsewhere. And as you're thinking about diversified portfolios like you were describing, that's where the opportunity is today, especially with changes in interest rates and interest rates starting to go down, investors beginning to reallocate, so flows now moving into different directions. There are opportunities elsewhere. And so it's one of those stories of don't always take the past for the present, and make sure that you are looking to the future, because that is what the market is doing.
Thanks, Chris. And the funny thing is, the next slide is going to talk about why some of the past is still okay. So, bringing it back to the AI story and the Max 7 and otherwise. So, um, we get a lot of questions about whether this is a tech bubble 2.0, 3.0. And there's a lot of ways of going through that conversation. One, we've talked about just these companies being, you know, profitable and generating cash flow. But this chart, this slide has been kind of really helpful. It provides a bit of context of what is today relative to the tech bubble. So what you're seeing on the left here is the actual, stock. You're looking at the earnings growth versus stock returns during the tech bubble, right? Looking at the S&P Technology Index, we're looking at specifically that piece of the market. And you can see you had earnings growth of 79%, so it wasn't devoid of earnings, but you had stock returns more than 5x that, right? That's when you have valuations disconnect from reality. Compare that to today, you do have stock returns outpacing earnings growth. Part of that's because the anticipation of further earnings growth. But if you compare the two, it's night and day. So we're not doesn't mean things can't get cheaper. This doesn't mean this, we'll never get to a bubble. But to say this is exactly, just a repeat of tech bubble 1.0, we still think that's probably the wrong way of framing what we're seeing these days. So let's jump to the next slide. Chris mentioned the election. I feel like we threw this slide in because we get asked the question so much that we have to explain this. So first, I'll focus your attention on the chart, but then I want to focus your attention on the bolded despite. So this is looking at quarterly S&P returns through by presidential cycle going back to 1950. And you can see year two, midterm year, is when you see the most volatility, particularly until you actually get to the election. In Q4, people realize what's happening and markets do better. And to be fair, listen, there's not, if you look at it, it's not necessarily a statistically significant number, but something that we get asked a lot about. I think what's also important is that this is with the despite. This occurs despite real GDP growth being the strongest in year two on average. And that's kind of the reality. Markets are a discounting mechanism for the future, and they don't like not knowing what's going to be the composition of Congress. And you get a bit of volatility. And we don't know if this will happen. This is an average. There have been very strong years in year two and otherwise. But this happens when you have very, very strong GDP growth. So take that for what it's worth, but giving you a bit of context there. So let's round out equities and get to bonds. How ultimately, we mentioned this in the first slide, this has been a year of fiscal monetary stimulus. You've also had very strong profits. You've had very strong earnings growth, and the AI spending, the hyperscaler spending, is only accelerating. Chris had a slide of, call it $500 billion of OBBBA, stimulus. Actually seven. I think five hyperscalers are going to spend 500 billion on that alone this year, with expectations of more going forward. So there's a lot of money flowing through. The lower interest rate is going to be relevant, particularly for the companies that are net borrowers that struggled with higher interest rates. So that is going to help the small mid-cap names. And we're obviously still constructive on things overseas. Not expecting necessarily them to match the AI-driven earnings growth in the US, but we have seen some fundamental pickups. We've seen some stronger returns in even European banks, which I think folks would have forgotten about for a while. So let's jump to bonds. Mr. Maxey.
All right. So we only have a couple of things we want to point out and highlight here before we wrap up. And I know there were a couple other questions we'll get into on the bond market. We did want to give everybody a sense of where we came from. If you go back to 2020, especially over the summer months of that year, bond yields reached historic lows, and that was a big part of the conversation. The line at the bottom is showing you where interest rates were based on each of those maturities, so 3 months out to 30 years. And even for a 30-year treasury bond, you were getting paid just over 1%. So if you held a bond for 30 years that was issued by the US government, you were going to get paid just over 1% per year. You can see how that changed and evolved at the end of 2024 and again at the end of last year. I would argue that this has been a healthy development in a lot of ways. Yes, it led to some amount of pain for fixed income investors in 2022. But where we've now reset to, it's allowing savers to feel compensated, for investing in fixed income. It's allowed people that do have cash, whether in a bank account or in a fixed income portfolio, to realize a rate of return that is now above inflation. And that's an important part of the dynamic here. What we're ultimately trying to do as we think about building a portfolio is grow real purchasing power on a positive basis, right? We want to improve people's financial pictures. We also want to improve their quality of life as time goes on. And the way we do that is by building a good portfolio across equities, across fixed income, and one that's going to grow faster than the rate of inflation. So when you look at the yellow line there, and we can begin to see that rates have come down a little bit from where they were, but by and large, we still see pretty favorable outcomes within the fixed income market, and that showed up in performance last year. So similar to what Dimitri was showing before, when you look at 2024 versus this past year, you have had a dynamic change where it wasn't just about taking on credit risk or owning riskier parts of the fixed income market. Last year, what we saw work was owning duration. And by duration, what we mean is having more interest rate risk in your portfolio. So owning things that are longer maturity in nature, owning securities that might mature in 5 years or 10 years, as opposed to owning things that were short dated. This was a big point of conversation several years ago when people were saying, hey, look, I can buy a T-bill at 5%, and clearly I could just roll that into perpetuity. So why wouldn't I go ahead and do that? Well, we saw that dynamic begin to change as the Fed cut interest rates, as inflation decelerated and slowed down, and rates naturally followed the path as well. So when you're looking at, hey, what happened to the broader bond market, this is where the opportunity was, and this is why you always have to think about composition. You can't simply assume that we'll be able to roll T-bills at 5% forever. It was great while it lasted, but we have to think about where these other opportunities are, where these other pockets are. And we've talked to people about private credit, and we'll speak about that in a moment. We've incorporated high yield corporate bonds into portfolios. We've added in TIPS as part of that core allocation. And we're not going to spend a lot of time talking about municipal debt today. That is something we've addressed previously, but even as you look at the muni market, there have been questions as to health at the state and local level financially, but right now, things are actually looking quite good for the vast majority of municipalities. So as we flip over, one area that we wanted to address, because there have been a lot of headlines around this, is the private credit market in particular. People, as recently as this morning, read an article in the Wall Street Journal about private credit and suggesting or implying that it's in a bubble, and we all need to be really cognizant and careful. We are going to put out a communication or a write-up on private credit and our thoughts, but we did want to share that the private credit is risky lending at the end of the day. So, what you're doing there is lending to companies that are either non-rated or they are rated at a high yield level. So it's not an investment grade company. It is a company that is lower rated. So when private credit was distributing 10 to 11%. It again, just like I was talking about with T-bills, it should not have been assumed that was going to last in perpetuity. More capital comes into opportunities when they are attractive like that, and that's part of what we've seen. Many of the articles are citing that capital has come into that universe, and so by extension, it's going to cause problems. We don't see that being the case. There's strong alignment of interest with borrowers and the company sponsors. There has still been a pretty healthy level of cash flow coverage. So when you're looking at the debt that needs to be paid off, there is still plenty of cash flow supporting the interest cost. And what we see is that as more capital flows in, it doesn't necessarily introduce bubble risk as much as it diminishes the return opportunity. So what we're showing here is a proxy for private credit, not a direct or exact substitute. This is the index yield for what are called bank loans. So banks would have previously played the role that we see private credit stepping into currently, and yields have been going down. These are floating rate obligations, and as interest rates are being cut, as interest rates are going lower, distribution yields have been following alongside. that is what you would anticipate or expect, more so than a blow up occurring or a bubble popping. That's not where we're at just yet with regards to that market. Dimitri, anything else you wanted
Yeah.
to add?
There's a lot which I think we'll address next week, but
Yeah,
banks have been absent from this space, so every direct lending firm is going to come to you and tell you that that's the story, and to be that's fair. I think what we're starting to see, in particular, which may suppress yields even further, is that um, we don't address too much deregulatory side of things on this call, but there is more deregulation coming. And, Basel III, which has had capital requirements for banks and was somewhat restrictive, seems to be losing some of its teeth with the implementation. And I think we saw something in the realm of, call it, 2 to 3 trillion of bank balance sheet flexibility being opened again, where banks are going to come back and start lending again. Now, that does not mean they're going to make great loans, but it does mean you have this dynamic of additional lenders. I think one of the emails we got raised the question of the oversight, because there's deregulation, which is not necessarily negative. The question is there going to be bodies in the room to review if people are actually following the new updated, less restrictive rules? And that's probably a fair point. We'll have some to address that. But as far as the stress, when we're talking to our managers in the underwriting, they do stress underwriting. You can't just lend to anybody willy-nilly. There's going to be more selective. There's going to be some stress. So you see that, but also that the headline risks that you've seen have not been less systemic in nature, have been very specific. So it's something we're keeping a very close eye on. We obviously have exposure for clients, but at this point, it hasn't been, run for the hills conversation.
yeah. So I think that's a great point. And ultimately we're not rah-rah for private credit. We're telling people manage your expectations, understand that defaults are going to be a natural part of the cycle here, and defaults were abnormally low, to be quite candid. So as we've seen the headline risk pop up, it's simply a function of defaults going to back to where they likely should have been for a long time because they were too low. So manage expectations appropriately here. Interesting opportunity, nice part of one's portfolio, but not an asset class that we would say you need to have too much of. Of course, it's a balance, like everything is in portfolio building. So to summarize on the bond market, the big takeaway for last year was that bonds actually beat their coupon, meaning that if we came in with distribution yields of 5%, the bond market outperformed mostly because interest rates fell further and faster than the market was anticipating. So you had the coupon, the income that was collected, but you also had interest rates lower, which was supportive of bond prices. On the muni market side, for top tax bracket individuals and households, especially in states like California, New York, and similar jurisdictions, munis are going to be attractive. For others, there remain opportunities outside of the municipal market, and right now we've seen that muni yields have come down pretty steeply. So you've got to be mindful of that trade-off and how you're building your portfolio. The one part of the conversation we started to get into, and we've talked about a little bit throughout, is inflation. Inflation impacts the bond market. It did so in 2022. It will again in the future. Markets are looking at potential inflation again of 3%, as we talked about earlier on, for this year. And as we move further out, around 2.25 to 2.5%. If we're not able to get that 3 down to 2.5, that's going to push interest rates up. It's going to push bond prices down a little bit, but not quite as severely as what we had seen a few years ago. So this is going to be the tension, that dynamic in the bond market that will continue to ebb and flow, and we've seen that happening for a few years. Then the last part was on the private credit. So 10% distribution yields are by and large gone. We would not anticipate that'll be here and available this year. There is still benefits in private credit. We didn't even get into asset-based lending, which is another unique segment of the private credit world that we've been talking about in other forums. But 10% distribution yields are gone. You need to probably start taking those expectations a little bit lower, especially if there's another cut that will, again, hit that distribution yield and bring it down one more notch. So we'll summarize and then see if there's any questions. I know there was one we had received, and then we'll let everyone get on their day. So in terms of market events, AI did bring back a lot of mojo to the market last year, which we had mentioned previously, and Dimitri went through that. Bond yields being stable has been beneficial to the stock market as well. We didn't spend a ton of time on that, but the more bond prices go or bond yields go up, that does present a headwind for companies, but also for the U.S. government. And we saw that happening right around the tariff time of the tariff announcements last spring. We've been reiterating for a time now that global diversification is really important in this type of environment. A lot of trends and things are happening, going in different directions than what we might have anticipated or expected previously, and international stocks doing better was a nice thing to have in portfolios last year. But the fundamental story there, as Dimitri walked through, is one that is still healthy and interesting going forward. So to the extent you don't already have international stocks in your portfolio, there is still an opportunity to incorporate those. On the economic side, we talked about Federal Reserve policy. We didn't talk about the change in the chair role. There's debate as to whether that will happen now come May. A few different things with regards to the Department of Justice investigation that is currently underway. Senators are saying they will not approve a new Fed chair until that investigation is over. Nobody seems to have great clarity on what all of that is going to mean and how quickly the investigation will conclude. So stay tuned on that. We will definitely be talking about it upcoming. Midterm elections, spent a lot of time on that. It's going to introduce some level of volatility, variability to markets. Doesn't necessarily mean it's a great timing opportunity because nobody's really quite sure when the volatility arrives. And as we've seen in the first couple of weeks, the economic support, both fiscally and monetarily, has been a strong tailwind for small and mid cap stocks. And that momentum is pretty strong at the moment. The question we always have to think about in the back of our own minds is the market running too hot, and is the economy running too hot? So on the economic front, there is a give back and there's a trade-off. If things are going really well right now, what does that mean for the future, and what happens in 2027 or 2028? Because eventually the market is going to look a little further forward than just the next 6 and 12 months, and it's going to say next calendar year. On the international side, geopolitics are there. I don't know if there's a whole lot for us to say other than what everyone else is also reading. Global order continuing to reshape. I think most importantly for us on the economic front is trade and tariff policy. And in thinking about that, the Supreme Court decision is going to be an important one. I don't know that it, in fact, is going to change anything though, because there are other plans in place to reintroduce tariffs, even if they are overturned. So we have a couple of questions. I will throw one up to Dimitri here. An asset class that has been doing well here recently has been gold and silver. Precious metals are in vogue, somewhat in contrast to what we see happening on the cryptocurrency markets. What do you see going on there, and what are our thoughts?
Sure. So listen, I think the question is, view on adding gold and silver portfolios, and we don't stand in the way. If clients want to do that, we give them guidance on what ETFs or what vehicles to invest there. Generally, when we think about commodities, we think about it as a broader basket, and it's an inflation hedging mechanism, right? When you get surprise inflation, we like commodities for that. So in 2022, for example, commodities did quite well in a surprise inflationary environment. But with regards to gold and silver, it's a tough one. Right now, we're actually looking at this. If you really look back and you go back to the 70s when we went off the gold standard, gold prices and to a degree silver prices stayed within a reasonable realm of how much it costs to actually get them out of the ground, right? Marginal cost of mining, and and gold was flat for a 20-year period between 81 and 2001, flat again for almost a 10-year period, up until a few years ago. But now it's hockey stick. Like, the marginal cost of getting an ounce of gold out of the ground is 1,400 an ounce, and gold's pushing 5,000. It's obviously translating into this is a more kind of a panic trade, or not even a panic trade, but just a risk trade in concerns about dollar, or the parties in place, or whatever it may be. So if you think fundamentally, presume some kind of return to normal, you probably wouldn't be doing this. That said, it does make sense for other reasons. So we are not proactively going out there and saying every portfolio must have gold or silver. At these prices, it gets a little bit tougher to do that. But if clients want to, they can. I know it's probably a non-answer, but we do like to look at fundamentals. We like to look at cash flows. We've been happy with what stocks and bonds have been giving. Um, Silver, I think, is up 200% over the last year. Gold's actually the least. Platinum, palladium have done quite well. Um, it's a tougher conversation for us for sure, but we're right now. If you think about across the firm, are we doing this? No, I think it's been
The
more
the
enough
the hang up
conversations.
for us has been the lack of cash flow. So as we're looking at assets that we do like to own, whether it's real estate, stocks, bonds, or commodities, there's always going to be a related or associated cash flow. So the ways that we think about protecting against inflation are like what I was mentioning earlier: infrastructure, TIPS, Treasury inflation protected securities. So there are other mechanisms for inflation protection that are based on cash flow. When you're thinking about gold, there's not inherent cash flow. So part of what you're relying on is, okay, central banks are purchasing more gold to diversify their central bank reserves. Interesting. We understand that. Is that going to last forever? Well, we've seen cycles of where that has been the case and where it's turned in reverse, and central banks have been net sellers. It appears that the central bank community will be there for some time now, and so that will be a supportive mechanism, at least on the gold side. But the lack of cash flows does create this dynamic where if the production cost, like Dimitri mentions, is $1,400 an ounce and the asset is trading at $4,500 an ounce, it's one of the more disconnected parts of the market where, supply is going to start increasing as mining companies try to extract more from the ground. It's not going to catch up, perfectly, but it will happen over time.
Yeah, I mean, there's only so much gold they can mine, but yeah, that's one thing that
Yeah.
mining companies used to do is when they can lock in these margins, they would sell forward production, they would hedge, and that would actually introduce gold into the market and suppress things down. Right now, they're rolling the dice, meaning they're leaving their portfolios unhedged. That is, to a degree, probably driving some of the upstick, but also we've seen this go badly back uh, in the 90s. So that the 20-year period of nothing for gold. So again, it's an interesting conversation. I think we'll probably have more as things evolve, but
Yep.
it's somewhat of a polarizing
Yes,
investment.
it is. So I know we're over the top of the hour. I'd like to wrap up there. We have a few other questions. We'll follow up with everybody and make sure that we get in touch with you. Appreciate people joining. If you're interested in the slides or the replay, we'll have that available. So don't hesitate to reach out. Appreciate everyone's support, not only today, but in recent years. And if there's anything we can do for you, please contact us, give us a call, reach out to your advisor. We are here to help in these moments. So thank you, everybody. Dimitri, great chatting with you, and we'll talk again next
Chris,
quarter.
thanks everyone.